Hello everyone, George DeSantis here with the look at the market for the week ending Friday, May 31st, 2019. And as usual, we bring up a disclaimer and take a look, read it, make sure you understand what it says, and we'll continue with the charts. I sent you an email on Wednesday, and we'll follow up today with the regular look at the market. So we'll start by looking at the weekly chart of the S&P 500. So here's a weekly chart of the S&P 500. It's pretty busy, but I'll try to see if I could make it clear for you. First of all, on this weekly chart, you can see that the moving averages, the 4 cross below the 9, and the price is now closing below the 50-day moving average. So on the weekly chart, we are closing pretty close to the 38.2 retracement level. That is at 27.23 on the S&P, and we're now at 27.52. So we're pretty close to the normal retracement of 38.2%, the Fibonacci retracement. So let's take a look at some other things. I have the Bollinger Bands with 1 standard deviation, 2 standard deviations, 3 standard deviations. What seems to be occurring here is that we have a squeeze developing. In other words, the bands are getting closer and closer together, especially these lower bands rising more rapidly than the upper bands. When that happens, as I think we've discussed before, the market, whatever it is, whether it's the index or stock, the instrument that you're looking at seems to make a more explosive move, either up or down. But the problem is you can't tell what direction this move will occur in. It could go up, it could go down. But we do know we get a more pronounced or explosive move once the bands come closer together. Lots of examples of that exist. The other thing is the parabolic is now above, been that way for 4 weeks, above the most recent bar. So that's indicating a downtrend, as we can clearly see here. We have had 4 weeks at least of a downtrend. The whole month of May really has been bad news for stocks. What else? We've clearly broken below this support resistance level of 28.15 or so. And now we ask the question, well, where do we go from here? It's quite possible that we find some support in this area, this 28.2% retracement level. Now, that's of course not considering any of the news items, the events that occur, tariffs, interest rates, inverted curve, yield curve, etc. This is purely looking at the charts. What are we seeing on the charts? Now, on MACD, MACD histogram just turned bearish, dropped below the 0 line. It's now at -5. Williams per centaur is still above the magenta line. And so that gives us a little hope, although it's not a strategy, it's still hope that we won't be suffering through a lot more of a drawdown here. RSI 12 likewise is still above 40%, that yellow line. And notice that when this trend started, it crossed above the 40% line right here. And it stays above that. And the research seems to indicate that once we're above 40%, we're not in a bearish market. So the bulls still seem to have some hope here. But let's take a look at a daily chart. And here's the daily chart of the S&P 500. A couple of things to note here. These moving averages really are very useful. If you take a look at the 4 EMA, the yellow line, the 9 EMA, the red line, back here, May 7, believe it or not, was the first day that we had a cross below of the course of the 4 EMA below the 9. I usually use that as a sell signal. Of course, I wasn't trading the S&P itself, but that turned out, in retrospect, to be a very good sell signal if you were trading the S&P, because look at it, it never went back above the 9 and it's still below the 9. All right, so that's insofar as the crossover of the moving averages is concerned. You can see that the 4 is still below 9, 9 below 30, and parabolic is still above the most recent bar. So the story here is that we are not out of the woods at all by any means. This thing can still go lower. We can go down to a 50% retracement level on the Fibonacci's as we saw. We can go, who knows how far down. Now, you see, we had if you remember, I pointed out this bearish divergence of MACD. As prices kept going up, MACD was trending down. Then we turned bearish here, right here, and MACD turned bearish, and we remained that way. We had some hope here that we were coming out of this, but no, the bears took over again and pulled the bulls down into the water, so to speak. So that's insofar as MACD is concerned. Notice too that we dropped below the 200-day average on the daily chart. This is the 200-day average. So we dropped below that. Now we're also hitting that 2 standard deviation Bollinger Band. So it's likely that we could see somewhat of a bounce here, but I'm not getting my hopes up too far here because I think this market is threatening to go lower. I would like to see it go higher because I still own some stocks, but it looks as though we might go lower before we turn around. Williams per centaur went bearish here, crossed down here, and it's still below the magenta line. And although RSI 12 is not as effective on the daily chart as the weekly chart, we could see that it's hovering around that 40% line here. So in summary, we still have a downtrend, and we don't know how far down is down. We have to wait and see where we get, if we get a turnaround sometime soon. Here's another chart you might be interested in. It's a daily chart of showing the Ishimoku cloud. Now, I'm not going to spend time on explaining what that is. You can look it up on the internet. But bottom line is that you want to be owning stocks when prices are above the cloud, and you want to be lightening up when prices are in or below the cloud. Right now, you could see that we're below the cloud, and that's not a good thing for stocks. Just wanted to point that out. So I posted something here from Barron's. It's we see the Dow Jones Industrials and the transports, and you can see they're both in downtrends here. So as far as Dow theory is concerned, we're confirming that downtrend. Now, if we take a look at the put-call ratio versus the S&P 100, it gives us a little more hope. Notice here, it is said here that when, let me expand this a little bit. It says when the ratio is at 60 or thereabouts, and the S&P is at 125, as they both are now, that's pretty bullish. We'll see. We hope so. Now, I put a paragraph in here that should also give the bulls and those of us who still own some stocks some encouragement. One analyst, Paulson, wrote this. Barron's wrote this about his analysis. But when the real private economy is signaling optimism at the same time the yield curve is screaming a warning, as it has been, Paulson finds that it's actually a buying opportunity for stocks. Looking back at the history since 1967, he constructed a model to compare consumer confidence with the 10-year Treasury yield. When this confidence gap has been in the highest quartile for the period, the subsequent 6-month return from the S&P 500 index averaged 14.34%, with a 20.36% probability of a decline, very low probability. When the gap between consumer confidence and the change in the Treasury yield has been in the lowest quartile, the S&P return has averaged less than half as much, with a much higher chance of a decline. Paulson's model is at 93% higher than all other 6-month time frames since 1967, which suggests stronger returns ahead. Hey, I hope he's right. Now, I made a list of a few stocks, and as we turn to individual stocks, I'm going to use the Shaken analytical software. So the first stock we look at is AFLAC, AFL, and what I'm looking for is stocks that are oversold and that have these other indications here, very good, bullish or very bullish indications here. I don't own any of these this time, but I'm putting it on a watch list. Them, I should say, on a watch list. We'll see where they go from here. 5 of them were up actually on Friday. Look at this one, this Cooper Medical Products. It was up like 3-4% on Friday. That's encouraging. Leidos Holdings, which is aerospace defense, had a nice move here, pulled back to the 21-day average, and now is sitting right above it. And it has these oversold, money flow look good, relative strength, etc. These are very bullish, and so I'm going to put them on a watch list. You can take note if you wish. Similarly here, we seem to be bouncing off for this Nuance communication software. We seem to be bouncing off the 200-day or long-term average. It's an oversold buy. X-Ray, I like this one particularly. Nice jump here, nice jump here, consolidated, jump here, consolidated. Now at the 21-day, very oversold and is very bullish. So this is one I'm particularly interested in. And this one here, Match Group, computer software, similar kind of chart. See, money flow looks pretty strong. Had a nice move, pulled back to the 21-day. It's oversold buy alert here. And these indications are good. It's now bullish. Now, Paycom, that has a nice run up here. It's now quite oversold, and it's running around that 21-day average. And money flow came back a bit, but it's still positive. Relative strength is still positive, so that's a good one. This is a new one. You know, if you want, it hadn't been around for a while. For a long time. It just became an IPO some time ago, and it was up nicely on Friday, up 6%, but I wouldn't buy it here. I would want to wait until I see a little pullback, and the money flow has been decreasing, so it's overbought, and I would wait for a while. Now, I think I'm going to call it a day here. I hope you had a good weekend. Market looks pretty treacherous. I'm taking some cover. I'm selling covered calls on stocks that I own, and I even sold a couple of stocks that were not bullish or very bullish. I'm looking to keep just bullish and very bullish stocks according to Shaken in my portfolio. I'm not going to hold anything that's not bullish or very bullish. So I sold a few. Have a good weekend. I hope you did.